When I was growing up, my favourite cricketer to watch was Dean Jones. He used to stand a foot outside his crease and he'd go after just about every ball that came down the pitch. However, as I got a bit older and started to understand the game a bit better, my allegiances started to migrate over to Mark Taylor. Mark had excellent batting technique, but what he did extremely well, game after game, was occupy the crease, put runs on the board. Occupy the crease, put runs on the board. It's not as exciting as watching someone try and hit every ball into the stands, but it's what Test match cricket is about. You put a high price on the value of your wicket and try and keep the run rate ticking along. When it comes to the markets, one of the things that I've found is that investors are often much less familiar with concepts of investment risk compared to concepts of investment return. Understanding investment return is intuitively quite straightforward. You buy a stock for, say, $1, it goes to $1.50, you can see a 50% return. Understanding the risk you took to generate that level of return, however, is harder to appreciate. Quantifying the amount of risk you took generally involves a good dose of financial mathematics, and more broadly, in my experience, a lot of investors are not familiar enough with what levels of risk are involved in different sorts of investment propositions. And that's important because investing is both risk and reward. Both parts of that equation are equally important. It's always much more exciting to listen to an investment proposition that talks about delivering high levels of return. In my experience, many of those sorts of propositions don't compensate you well enough for the risk that you're taking with your capital. There's a reason that we remember Dean Jones as a one-day specialist today, while Mark Taylor went on to open the batting order for the Australian Test team for the best part of a decade. At the Global Value Fund, we put a lot of time and energy into managing risk, while still aiming to generate solid investment returns. And what we hope to do with the fund is generate equity market-like returns, but with about half of the risk that comes from owning a portfolio of international shares. That's a tough target to set for yourself, but to date we have managed to deliver on this. There's lots of different ways to show that, but I think the chart we're going to show here is the simplest. It shows our drawdown history. So it shows every down month that global share markets have had since our IPO, and beside that it plots our return in the same corresponding month. Despite this lower risk profile, to date, we have managed to deliver on our return targets. Obviously, our performance is not always going to live up to the goals that we set for ourselves, but what we're hoping to achieve with the fund is a product that could be an important part of your overall investment portfolio. We certainly do not sit at the crease looking to hit every ball over the fence. Rather, we want to face that hard ball for you at the beginning of the day and aim to still be there with you at the end of the innings.